First things first, does Europe have enough LNG terminal capacity to receive the quantities being discussed currently?
Yeah, so not currently. We're already seeing that European regasification capacity has been running near capacity for the last 2 months, and that has created constraint pricing in Northwest European gas hubs, and also creating a dislocation between the European gas price and the global gas price, which are now well separated. That can be really identified in the Platts DES Northwest European LNG marker, which traded at a record $10 per MMBTU discount to the TTF in May. But over the last few days, we've seen that spread has tightened to closer to about $4 per MMBTU, which is suggesting that constraints into Europe may be easing, although we still think that they lack the necessary regasification capacity to fully replace Russian gas.
How has US LNG exports to the EU fared in the month of May compared to recent months and compared to historical seasonal averages?
U.S. exports to Europe have been quite high. We've seen about 195 million cubic meters per day delivered to Europe, which is an increase of about 74% year on year. Now, at the same time, we've seen a massive decline in U.S. LNG deliveries to the Asia Pacific countries, which have fallen to just 66 million cubic meters per day. It's down about 47%. Now, this shift from Asia back to Europe has been extremely notable, and it has been a key feature of the energy crisis in Europe, and has also exemplified the flexibility in U.S. LNG supply. However, over the last month, we've actually seen cargoes start to shift back towards Asia Pacific because of regasification constraints in Europe, and they are no longer able to take any more gas, and we're seeing those large discounts incentivize cargoes to again move eastward.
What is the current capacity utilization rates at US LNG export terminals?
It's very high. In May, we've seen utilizations average around 94% of peak observed output. That's about 2% higher than what we saw a year ago. And this is despite the fact that we've seen several late season maintenance even rolling off just this past month. June utilizations, during the first few days of this month, have averaged about 97%. And that is because we've seen major maintenance wrapped up at Cameron and Freeport. Now, on top of this, we're seeing a very strong ramp and faster than expected ramp at the newest U.S. export facility, Calcasieu Pass, which we expect to see reach full capacity this summer.
Ross, despite the European urgency for more LNG, it seems it only wants to lock it in for no longer than the next 10 years only. As such, will EU LNG import contracts carry sufficient durations to encourage LNG project final investment decisions in the US or even elsewhere for that matter?
Yeah, it's a good question. I think even without these European contracts, we believe that many U.S. LNG export projects will reach FID without them. Platts is currently tracking around 63 million tons per year of contracted capacity for North American LNG exports across this full third wave of projects. And that's likely enough to get at least 3 to 5 additional LNG export projects to FID. Now, of those contracts, only about 17 are signed with European buyers. 17% are signed with European buyers. Portfolio traders, this would be your traditional global major oil and gas companies or commodity traders, are actually taking up the most volume. About 45% of contracts are signed with portfolio players, while China is taking about 28% of contracts. So it's possible that if Europe wants US LNG down the road, they will either need to competitively bid for it, which means taking a longer term, perhaps a 20-year contract, and trading those unneeded volumes back to Asia down the line. Otherwise, they may need to sign a secondary shorter term contract with one of these portfolio buyers or a commodity trader. But in that case, they may be paying a premium for that shorter term, but also have the optionality to leave that contract earlier. So I think it'll be a combination of signing long-term contracts, which we've seen already, but also purchasing some of the volume either on a short-term basis from a secondary supplier or by purchasing in the spot market.
Would the methane emissions footprint of US produced natural gas stand in the way of a significant growth in longer-term US LNG imports into the EU? And how could US gas producers assuage those European concerns?
Yeah, methane emissions were a major reason why development of US LNG export projects stalled out in 2020 and 2021. And now the current need seems to replace Russian gas supply is seeming to outweigh European environmental goals. It's likely that methane emissions will likely reemerge as the European energy crisis eases. But at the same time, the experience of 2020 and 2021 led many US LNG export project developers to look for ways to solve some of these upstream methane emissions issues and carbon emission issues. So that includes using certified natural gas for feedstock, which certifies that the gas is coming from a low methane emission basin. And on top of that, adding carbon capture and storage technologies at the liquefaction site to capture the carbon produced in the liquefaction process. So I think the combination of these two solutions, while imperfect, could provide the needed leeway for some of these export projects to meet some of their European energy environmental goals down the road.
U.S. Energy Secretary Jennifer Granholm has mentioned recently that the U.S. government has permitted almost 3 times as much LNG capacity as the U.S. currently is exporting. As many LNG facility permit holders have not begun construction yet. Why the delay?
Yeah, well, many projects have applied and, in fact, been permitted to export. But the reality is that only a few of these projects have actually achieved a level of commercialization that would guarantee cash flows to the extent that it would entice a bank or a group of financiers to provide financing for the project. So in many ways, export permits are really the easy part of the project development process. Getting buyers to sign up long-term contracts and subscribe for capacity is really the harder part, and it's usually the last major step before you reach FID and begin construction. So the reality is that many of these projects simply have not been able to entice buyers to sign up for those long-term contracts, and the demand may simply not be there for the full amount of export capacity that is currently permitted.
Has the Biden administration, as some in the American natural gas industry proclaim, been ambiguous about its stance on the long-term role of natural gas in the energy mix and thus hampering efforts for further gas development and LNG terminal construction?
It's possible, but I would sort of couch this in the broader environment that the U.S. natural gas market remains a highly liberalized gas market. And while the Biden administration has made some changes that could hypothetically slow down investment in natural gas, the broader trend has continued to be more investment and not less, particularly in terms of LNG exports. I think right now what we're seeing, especially in U.S. upstream investment, oil and gas drilling, is slower or is a lack of financing and capital discipline on the part of the producers. So over the last few years, banks and producers have both dialed back investments, overall the amount of debt that they're willing to hold in oil and gas, due to a prior environment of over leverage and too high of risk. I mean, it's worth noting that just 2 years ago, we saw the WTI price trade negative for the first time ever. And I think that this is a learned experience, that there are massive commodity cycles, perhaps even more volatile commodity cycles, and that has really changed the risk paradigm of the oil and gas sector, and also the financiers that are putting money into the sector. And I think that that might be the major hurdle for energy investment currently.
How do you think the competition will play out on US LNG shipments between Asia and Europe later this winter?
Yeah, it's likely that there is going to be direct competition again between Europe and Asia. Certainly, Europe is going to need to continue to bring in spot volumes to meet the shortfall in Russian gas. At the same time, Asia, most of the Asian buyers still require spot volumes to meet peak winter demand as well. Now, the extent to which Asia can shed spot LNG demand and replace that with coal, potentially fuel oil, and with energy savings is not yet certain. And certainly, we've seen a large amount of demand response from Asian buyers so far this year. So that level of competition could be less than what we saw last winter. But given colder weather, given any type of demand shock, certainly we would see lots of price volatility and direct competition between Europe and Asia for some of those very scarce spot LNG volumes.
So, Ross, given that analysis, do you expect LNG prices between Asia and Europe to further converge in the medium to longer term?
Yes, I think it's likely. The big differential between European and Asian LNG volumes right now is being driven by those capacity constraints at the Regas terminals into northwestern Europe. And as those capacity constraints become alleviated, which we expect they will over the next couple years with the addition of a number of new regasification facilities across northwestern Europe, those differentials will normalize to simply just transport costs. And so, yes, we do think that there'll be a convergence. And then on top of that, there will likely be a convergence towards a lower price as global LNG supply responds to this current period of high demand.
Does the EU have enough regasification capacity to hit those 2022 targets that it's set for itself?
Yes, it likely does. We're seeing a tremendous amount of gas delivered to Europe currently. In 2022, we've actually seen many of the European regas facilities running above capacity, and as well, we've seen capacity expansions added to several facilities across Europe just over the past couple months. So they've been utilizing their facilities really as much as we could expect. As we get into the summer, we may actually see some underutilization of those facilities, at least below capacity. And assuming that Russian gas deliveries from pipeline gas continue at take-or-pay levels. So there does appear to be enough regasification capacity for the 2022 targets, but certainly not enough to replace Russian supply yet.
Can you give our viewers a snapshot of the US LNG industry's actual capacity currently under development?
Yeah, so it's quite a few projects, upwards of about 10 separate projects representing almost 120 million tons per annum of capacity that we are currently seeing. New contracts either announced or non-binding HOAs announced. And we think that there's long-term contracts underpinning about half of that. So it's a massive build out. And it shows that there's not just one or two projects that may be going forward. There are a number of projects that are showing promise and could potentially get across the finish line.
Final question. Is there enough natural gas being developed or produced to liquidate in the US? And what needs to be built first, the liquefaction facilities or the US gas production? Is it a chicken and egg problem? What's your outlook for US natural gas production in the short to medium term?
Yeah, so our belief is that there is enough gas in the United States. Certainly, the gas basins that are even, within close proximity to to the U.S. Gulf Coast's LNG export facilities, the Haynesville, the Permian, and potentially further up into the mid-continent, into the Scoop Stack, have tremendous gas reserves. Now, the trick is going to be able to send the correct signals for gas producers to begin drilling again and providing that supply for these new LNG export projects. I do think, though, that to some degree we would expect to see FIDs for liquefaction projects first. Then we would see those tolling buyers, the capacity holders at those facilities, sign up for long-term supply contracts with U.S. producers, and then those U.S. producers establish a drilling program in order to meet that growing supply. Now, it wouldn't be perfectly one for one, but I think once you get the buyers on board, then the gas producers will line up to sell that gas and will increase their drilling in order to meet that demand.